Level 1. Structuring. You have $18,000 in cash. It is sitting in a bag. Maybe it came from somewhere legitimate, maybe it did not. The law, as it turns out, does not particularly care about that part yet. Here is the problem. Banks are legally required to file a currency transaction report on any cash deposit over $10,000. The moment that form gets filed, your deposit is in a federal database. Automatic. No suspicion required. Just a deposit and a keystroke. So the first thing everyone learns is the rule that sounds like a workaround. Never deposit more than $9,900 at once. Split the $18,000. 2 deposits, 2 branches, 2 different days. Except it is not a workaround. It is a federal crime. This is the part that trips people up. Structuring deliberately breaking up deposits to stay under the reporting threshold is illegal, regardless of where the cash came from. Your money could be completely legitimate. You could be a farmer who collected rent in cash for 20 years and simply does not trust the internet. It does not matter. The act of intentionally splitting deposits to dodge the threshold is itself the crime. 5 years federal prison, a $250,000 fine for the deposits, not the money. And here is what makes it worse. Banks do not only watch for deposits over $10,000, they watch for patterns of deposits suspiciously clustered just under it. A compliance officer who sees the same person making $9,800 deposits at 2 branches in the same week does not need a threshold to get suspicious. She needs a pattern. And structuring almost always produces exactly the pattern it is trying to avoid. Most major banks now run automated compliance software that compares deposit timing and amounts across branches in ways no single teller ever could. A behavior that looks like a clever workaround to a human looks like a flashing red light to a machine that has seen it 10,000 times. Most small-time laundering ends here. One suspicious activity report away from a federal financial crimes referral. The money is technically in a bank account. It is nowhere near clean. Level 2, the cash business. You buy a laundromat. The irony of laundering money through a laundromat is so perfect it almost feels intentional. It is not, but it is. The reason criminals love cash businesses has nothing to do with charm and everything to do with arithmetic. A laundromat, a car wash, a nail salon, a parking lot, a vending machine route, these are businesses where revenue is real. Customers pay in cash and nobody issues a receipt, which means reported revenue is essentially whatever you say it is. The method is simple. If the laundromat legitimately earns $4,000 a month in quarters, you report $6,000. The extra $2,000 in dirty cash rides along as normal business income. You deposit it, you pay taxes on all $6,000, which feels completely backwards until you realize that paying extra tax on fake income is a small price for converting illegal money into legally taxed, legally deposited, legally documented revenue. You are voluntarily overpaying your taxes, which makes you, technically, the most patriotic criminal in America. This works because nobody can easily disprove a cash business's revenue without extensive surveillance that most agencies will not spend on a laundromat unless something much larger is already under investigation. The catch is, the investigators who specialize in exactly this level, they do not start with the deposits. They start from the other direction. How much water is the laundromat purchasing? How much detergent? How much electricity? A business claiming $6,000 a month in washing revenue but buying supplies sufficient for $3,000 worth of washing is not a mystery, it is an answer. A very inconvenient one. The other limit is scale. You can only launder roughly as much as your business could plausibly earn. A single laundromat generating $6,000 a month cannot absorb $2 million in dirty cash a year without attracting the kind of attention a laundromat has never attracted in its entire existence. The method works. It just has a ceiling. Level 3, shell companies and fake invoices. A shell company is a business with no employees, no customers, no product, and somehow a very busy bank account. It exists on paper, registered with a state, often with a real address, which is typically a mailbox at a commercial mail service in Delaware that shares its zip code with 400 other companies that also, coincidentally, have no employees, no customers, and no product. The mailbox is working harder than anyone in this arrangement. Here is how it works. The shell company invoices a legitimate business, your laundromat say, or any real company you control for consulting fees, marketing services, advisory retainers, services that were never performed but are documented to look like they were. The legitimate business pays the invoice. Money moves from a business that has to justify its income to one that never has to prove it did anything because, on paper, it did. This is called layering. moving money through multiple transactions specifically to obscure its origin. Each transfer looks individually unremarkable: an invoice, a wire, a payment. A dozen shell companies across 3 states later, and the original source is buried under so many layers of paperwork that reconstructing it requires an investigator to obtain every single record simultaneously, which is exactly the difficulty that was designed in. This is also where the professionals appear. Setting up a shell company network correctly with the right jurisdiction, the right paperwork, the right distance between entities is not something most people improvise. It is a service. And that service has its own quiet referral network among people who have already crossed this line. The lawyers and accountants involved often operate under what the law calls willful blindness. They technically do not know where the money came from. They have technically not asked. They have technically created a completely legitimate corporate structure that happens to be used for completely illegitimate purposes. Willful blindness is not a defense. It is just a defense that sometimes works. Investigators cracking a shell company network rarely start with the invoices. The invoices are designed to look clean in isolation. They start with the connective tissue, the registered agents, the formation addresses, the accountants tying multiple entities together. A dozen unrelated seeming companies sharing one mailbox service is not a coincidence. It is a fingerprint, and fingerprints survive even the most carefully cleaned scene. Level 4, real estate. Property valuation is not a science, it is a feeling. And feelings, as it turns out, are very hard to prosecute. You buy a rundown property for $200,000 structured, of course, to avoid reporting thresholds, and financed partly through a lender who is either very trusting or has made a quiet decision not to look too carefully. A year later, you sell the same property to another shell company you control for $500,000. Nobody can definitively prove that price is wrong. Property values are subjective. The market moved. Location, potential, vision. The $300,000 difference is now clean profit from a perfectly documented real estate transaction, at least on paper. Real estate became a favored large-scale method for one specific reason. In many jurisdictions, cash purchases of property faced less anti-money laundering scrutiny than an equivalent cash deposit at a bank. A bank teller is legally required to file reports on suspicious cash transactions. A real estate agent closing a $2 million all-cash sale through an anonymous shell company was, until recently, under no equivalent obligation to ask any questions whatsoever. This gap became so visible that American regulators finally moved to close it. In August 2024, the Treasury Department's Financial Crimes Enforcement Network published a sweeping new rule requiring beneficial ownership disclosure for all cash residential real estate purchases by LLCs, trusts, and other legal entities. Effective December 2025, the loophole is closing, roughly 40 years after it opened. The scale advantage is the real appeal of this method. One property flip can clean hundreds of thousands of dollars in a single transaction. Multiply that across multiple properties, multiple cities, multiple shell company buyers, and you can clean millions without ever producing the kind of cash deposits that catch launderers still stuck at level 1. Real estate professionals and title companies have long occupied an uncomfortable position here, handling transactions of comparable or greater size than banks, with a fraction of the reporting obligations. Where those rules have not yet caught up, real estate remains one of the most reliable large-scale laundering methods available. Precisely because the professionals facilitating the sale often have no legal obligation to ask the questions a bank teller would be required to ask about the same amount of cash. Level 5, offshore structures. The British Virgin Islands has a population of approximately 30,000 people. It has approximately 400,000 registered companies. That is 13 companies per person. The goats in the British Virgin Islands are, statistically speaking, running LLCs. At this level, the problem with domestic methods is not that they stop working. It is that domestic banks, domestic property records, and domestic tax authorities all share information with each other in ways that eventually connect dots you need to stay disconnected. The offshore solution is jurisdictions specifically chosen because the public record never has to show who actually owns anything. Money moves into an offshore account held by a shell company, which is owned by a trust, which is administered by a local agent, who has no legal obligation and often no practical ability to identify who is actually behind the structure. The agent is paid to not know, professionally. This is, in certain jurisdictions, a legitimate career. Layering at this level means moving money through multiple offshore jurisdictions in sequence, a wire from one country to a company in a second, to a loan to an entity in a third each hop, adding a jurisdiction that must individually agree to cooperate before any investigator sees the full chain. Some jurisdictions cooperate readily. Others require years of diplomatic and legal process before a single record gets released. Some simply never do. The leaks changed everything. In 2016, the Panama Papers exposed 11.5 million documents and over 214,000 offshore entities from a single law firm. Governments recovered $1.36 billion in taxes and fines from those documents alone. In 2021, the Pandora Papers leaked 11.9 million records from 14 different offshore service providers, exposing the financial secrets of 330 politicians and 130 Forbes billionaires across more than 200 countries. What those leaks revealed was not a few rogue operators. It was infrastructure. Industrial-scale infrastructure processing clients, from ordinary tax avoidance all the way to serious criminal laundering, all running through the same handful of formation agents using largely identical paperwork templates. The system did not look like crime, it looked like filing. The leaks did more to expose the mechanics of offshore laundering in 1 week than years of regulatory enforcement had managed on its own, simply because investigators finally saw the entire client list at once, instead of one suspicious transaction at a time. Level 6. Trade-based laundering. This is the level regulators consistently describe as the hardest to detect. It is also the largest, by a significant margin. Trade-based money laundering accounts for an estimated $1.6 to $2.2 trillion in illicit funds annually. According to FATF, the Financial Action Task Force, the global body that sets anti-money laundering standards, it represents approximately 80 to 85% of all global illicit financial flows. The method nobody talks about is the method doing most of the work. The technique is elegantly simple. You ship a container of goods across a border: furniture, electronics, textiles, anything with a market value that is real but genuinely difficult for a customs officer to independently verify on a loading dock. You invoice the shipment for far more than the goods are actually worth. The importing company, which you also control, pays the inflated invoice. The difference between the real value and the invoice price is dirty money that has just crossed an international border, disguised as a legitimate trade payment. A shipping container of furniture invoiced at $4 million. Nobody checked whether the furniture was worth $4 million. Nobody realistically checks individual containers for price accuracy. Customs agencies are built to catch smuggled goods and tariff evasion, not to audit whether a declared price for a mixed goods shipment is commercially reasonable. That is an entirely different skill set, requiring an entirely different database. Under-invoicing works the same way in reverse. Ship genuinely valuable goods, but declare them for a fraction of their worth. The receiving company sells them at full value and pockets the difference as legitimate sales revenue. Colombian drug cartels perfected a version of this called the black market peso exchange decades ago, converting drug dollars into consumer goods in the United States, importing those goods into Colombia at inflated invoice prices, and distributing them through legitimate retail channels. The mechanism was documented by law enforcement. The scale was staggering. And for years, it ran through ordinary international trade completely undetected because it looked exactly like ordinary international trade. Detection requires comparing declared prices against a global database of what similar goods typically cost across thousands of comparable shipments. A single unusual invoice might have a legitimate explanation. A company that systematically prices its shipments at the outer edge of plausibility across hundreds of transactions over years is a statistical anomaly that eventually becomes a pattern. Eventually, after years. Level 7. Cryptocurrency mixing. The blockchain was designed to be the most transparent financial system ever built. Every transaction permanently recorded, publicly visible, traceable forever. Criminals heard this and immediately thought, perfect, challenge accepted. Cryptocurrency mixing services, sometimes called tumblers, work by pooling deposits from many different users and redistributing equivalent amounts to new wallet addresses, deliberately severing the direct on-chain link between where funds entered and where they exited. Your dirty cryptocurrency goes in. A functionally equivalent amount, pooled with everyone else's deposits, comes back out to a fresh wallet address with no traceable connection to where it started. In 2019, Tornado Cash launched as one of the most sophisticated mixing protocols ever built. By the time American regulators sanctioned it in 2022, it had processed over $7 billion in transactions, including approximately $455 million for North Korea's Lazarus Group, a state-sponsored hacking organization that had stolen the funds from cryptocurrency exchanges and needed somewhere to put them through the wash. In the Netherlands, Tornado Cash co-founder Alexei Pertsev was sentenced to 64 months in prison for money laundering. In New York, co-founder Roman Storm was convicted on related charges in 2025. That same year, the founders of Samurai Wallet, another mixing service that had processed over $200 million in illicit transactions, pleaded guilty to conspiracy charges in the Southern District of New York. The blockchain's fatal irony for the launderers who rely on it is that its permanence cuts both ways. Every transaction is visible forever. Blockchain analytics firms have built entire businesses reconstructing the movement of funds through mixing services, analyzing timing patterns, transaction clustering, and amount distribution across a mixer's entire transaction history. Mixers can break the obvious direct link. They cannot erase the underlying data. And when a mixing service is seized, its own transaction logs retroactively unmix years of activity in a single stroke. The technology promises anonymity. In several major documented cases, that promise turned out to be temporary rather than permanent, lasting only until the service itself became the target. Level 8, Correspondent Banking. In 2012, HSBC admitted to laundering $880 million for the Sinaloa cartel, the organization run by Joaquin El Chapo Guzman. The settlement? $1.9 billion. Their annual revenue that year, approximately $89 billion. The fine was roughly 2% of annual revenue, a parking ticket, with extra steps. Then, according to subsequent investigations, they kept doing it. Correspondent banking is the system that allows banks in different countries to process transactions on behalf of each other, essential infrastructure for international finance, and the largest single channel through which sophisticated money laundering has moved at institutional scale. A bank in a jurisdiction with weak compliance processes passes transactions through a correspondent relationship with a major Western bank. The Western bank's own due diligence is supposed to catch the problem. Sometimes it does, often, apparently, it does not. In 2020, a trove of confidential suspicious activity reports was leaked to journalists through an international collaboration, the FinCEN files. The documents revealed $2 trillion in suspicious transactions processed between 1999 and 2017 across 5 of the world's largest banks: JP Morgan, HSBC, Standard Chartered, Deutsche Bank, and Bank of New York Mellon. Deutsche Bank alone accounted for $1.3 trillion of that total. The transactions had been flagged, the reports had been filed, the business had continued. The mechanics of institutional failure at this level are usually more mundane than they appear from the outside. It is rarely a single executive knowingly approving cartel deposits. More often, it is an understaffed compliance department processing thousands of alerts a day against a bonus structure that rewards transaction volume over suspicious activity flags. A correspondent relationship deemed too profitable to properly scrutinize. A culture in which the obvious question is never asked at any of the dozens of moments someone could have asked it. The largest money laundering scandals in banking history tend to look from the inside, less like conspiracies and more like slow institutional decisions to not look too carefully for a very long time. Level 9, the whistleblowers. Every major money laundering network that has ever collapsed was not ultimately brought down by forensic accounting. It was brought down by a person. Usually someone who got passed over for a promotion. The entire FinCEN Files investigation, $2 trillion in suspicious transactions, 5 global banks, years of documented regulatory failure originated with a single source. Natalie Edwards, a former senior analyst at the U.S. Treasury's Financial Crimes Enforcement Network, copied 2,100 suspicious activity reports and passed them to a journalist. She was later prosecuted and convicted for the leak. The investigation she enabled exposed more institutional laundering infrastructure than years of routine regulatory review had managed on its own. The reason is simple. An investigator working from outside a network can subpoena records, trace transactions, and build a paper trail, all of which takes years and may never fully reconstruct what actually happened inside. An insider already knows the shell company structure, the executive who decided not to ask the question, where the real records are versus where they are supposed to be. That knowledge compresses years of external investigation into information that is already complete. Behind almost every major prosecution in this space, there is a person in the background. An accountant who kept records they were not supposed to. An employee who watched something happen for years and finally decided enough was enough a shell company's registered agent who eventually agreed to talk to investigators after years of quiet unease about exactly whose money they had been moving. Whistleblower protections have expanded significantly in recent years, specifically because regulators understood this asymmetry. The IRS whistleblower program now pays between 15 and 30% of collected proceeds from successful cases, a financial incentive built explicitly to make the calculation for a disgruntled insider increasingly difficult to ignore. Every method in this video can survive external forensic scrutiny for years. Almost none of them survive a single motivated insider deciding they are done staying quiet. Level 10, how it all unravels. Here is the thing about dirty money. Every step it takes has to be explained. Every explanation becomes a record, and every record outlives the transaction that created it. Financial intelligence units, FinCEN in the United States, and equivalent agencies internationally exist specifically to aggregate suspicious activity reports, currency transaction reports, and cross-border wire data from every institution across every jurisdiction into a single picture no individual bank, regulator, or country could ever construct alone. A shell company invoice looks completely unremarkable in isolation. The same invoice cross-referenced against 40 other transactions flagged by different banks in different countries over several years starts to reveal a structure that was always there waiting for someone with enough of the pieces to see it all at once. Machine learning systems are now being deployed across financial institutions specifically to find the connective tissue that human analysts miss, the timing correlations, the network structures, the statistical anomalies that only become visible when you are looking at millions of transactions simultaneously rather than one suspicious deposit at a time. Most major laundering prosecutions take years to build for exactly this reason. The individual steps are each designed to be unremarkable enough to survive scrutiny on their own. What eventually convicts the people running these operations is never a single transaction. It is the slow accumulation of every transaction across every level, laid out together in a single case file, that finally shows the one thing dirty money was always trying hardest to hide. A straight line, however long, however disguised, connecting exactly where it started to exactly where it ended up. And yet, the United Nations estimates that investigators successfully identify and intercept approximately 1% of laundered money globally. The $2 to $5 trillion that moves through this system every year through the laundromats and the shell companies, the property flips and the offshore trusts, the shipping containers and the blockchain mixers and the correspondent banking relationships, roughly 99% of it comes out the other side. Clean, documented, legal. The system does not fail. It works exactly as designed. The question is just who designed it and for whom. Between $2 and $5 trillion went through this process last year. Most of it came out looking exactly like yours.